good afternoon, everyone, and welcome to today's webinar, whatever property investor needs to know about construction loans. Now, we want this to be as engaging for you as possible. So as questions come up, please go ahead and use that little questions function, and I will ask the speakers on your behalf. This webinar is being recorded, and I will send you a copy of the slide deck after the webinar. So with that, I am going to turn it over to today's speakers. Oops, sorry. Take it away, Dave.
All right, thank you very much, Rose. Happy to be here today. Happy that everyone has joined us. Hopefully, you can answer every question that you have and just explain why fix and flip and ground up construction is so hot in today's market. My name is Dave Cannon. I am a sales manager on the fix and flip and ground up construction team, joined by Ray Hashimi.
How's it going, everybody? My name is Ray Hashimi. I'm an account executive here at Lensure, and happy to dive into this webinar on our fix and flip and ground up programs.
You can go next slide. So just a little bit about us. Lensure was founded in 2015. We have our headquarters here in San Diego. That's where Ray and I are. We have centers in Rhode Island, Georgia, Utah, and Missouri. Very highly experienced management team that definitely have a lot of experience on the fix and flip and the construction world, over 500 of these in the last couple of years. You can go next slide.
Yeah, just to show you guys a little bit about what we do, here is an example of a mid-stall construction project that initially an investor had run out of capital for it. We had an investor that came in, found it off market, was very experienced in the space, figured that he could get it turned up in 6 to 9 months. We were very comfortable with the borrower's experience, so we went ahead and we gave him a loan for this one. And then in the next slide, we'll show you the finished product of what it came out to be. And here you go. Looks like a beautiful job well done by him. And yeah, that's an example of one product that we offer, which is mid-stall construction rehab. And it's one of our specialties here that separates us from other lenders that sort of might shy away from a project like that.
No, next slide. So just a brief program overview. We need to close these in the name of an LLC. The LLC doesn't have to be seasoned. You can open it a few days before the closing. You want to talk to your tax professional about the potential benefits of closing in an LLC. In terms of our product, we're not doing commercial properties. We don't do mixed use, and we don't do large acreage. What is large acreage? When you get over 2 acres, it's going to be on an exception basis. We can usually go up to 5 acres. Mixed use is kind of a case by case, so I wouldn't shy away completely from mixed use, but it would be off sheet. We work with any level of experience, so if you have 0 experience, we can put a loan together for you all the way up to very seasoned builders. The more experience you have, the more leverage we provide. We have a very streamlined application, can close quickly, same month closes. There are no, the standard TRID, IRLA don't exist. These are going to move fast just from the standpoint that there is no DTI calculation, so there is no income evaluation. We'll get into some of the tenets of how to put this loan together here shortly, but no income usually means that the loan is going to close a lot faster. You can go to the next slide.
Here are 4 pillars that we really look at when evaluating each deal. Project, the borrower's assets, their credit history, their experience. I typically like to look at this going from right to left. We really like to zero in on the borrower's experience. How many projects have they completed in total? What we really like to zoom in on is how many projects they've done in the last 36 months in particular. That'll give us a pretty good idea for how experienced they are in the space. We do like to see projects of similar scope having been completed in that time frame. And it would be in the borrower's own name rather than, capital injection that they might have done on a buddy's project, for example. Credit history, we are still pretty aggressive, even at a minimum of 660 FICO. you do have the opportunity to get up to 80% loan to cost, even with the 660 if the deal pencils out. And we do consideration for major credit events. Assets, as you might understand, are there enough assets to cover the project, down payment, closing costs, payment reserves, funds to get the project off the ground, and the project itself. Location, purchase price, rehab budget, and the ARV are all factors that we consider when evaluating each loan. And yeah.
And just to add, we call these basically the four legs of the stool. These four things are where every credit determination comes from. You can go next slide.
Okay, I have a question. I completed a fix and flip on a $200,000 house 4 years ago. Would this count towards experience if I'm seeking financing for a $1 million rehab?
So we would want that experience to be 36 months or sooner. In terms of the project size or it being commensurate to the current project, we can do them. Let's say you have a $400,000 experience in the last 36 months and you're looking to do $1 million. We can give you credit for that as long as the project itself is somewhat similar. Obviously, it's going to be a bigger house, bigger square footage, or maybe not. Maybe you're in an area that is just more high end. So we would, if inside of 36 months, give that consideration as experience, but outside of 36 months, we would not.
Okay, and one more question. You mentioned a minimum FICO of 660. Do I get better loan terms if the FICO is much higher than that?
So the answer is yes. A lot of it has to do with the leverage. We can provide more leverage when that score goes to 700 or better. There are also programs that we have when we get into the upper echelons where 720 is better. In terms of rate, pricing, things like that, that is usually based on the exceptions that need to be made or just the actual overall parameters of the file. But yes, 700 will get you a little bit more than 660 will.
Okay.
And you go to the next slide.
Yeah, for our ground up construction loans, we would like to see the builder have at least 3 completed new builds in their name. As you might understand, ground up is a little bit more high touch than a typical fix and flip rehab. So we do want to make sure that the GC, or if it's an owner builder scenario, either or, we want to make sure they have at least 3 new builds under their belt already, and preferably of similar scope to the project that we're looking to lend on. We will lend on the cost of the lot and the cost to build, and we'll even reimburse the builder for up to 65% of the lot purchase price. And we even do delayed purchase financing, so they could come to us, 6 to 9 months after the lot purchase price. Say it took them that long to get the project entitled, permits in hand, we'd go ahead and reimburse them for up to 65% of that lot purchase. And we do 12 and 18-month term options typically with IO payments, no prepayment penalties. And we do 24-month terms, but that's on an exception basis only. And yeah, as you'd expect, we review the project details, builder experience, like I mentioned, assets and credit to determine the loan pricing. And yeah, it's going to be the 4 legs of the stool, deal in, deal out.
And just to make a distinction here, we have the investor experience going back 36 months. That's how we determine the leverage, how our thresholds are going to be applied. This is talking about the builder themselves on a ground up construction loan. You want to have a experienced builder to build this house for you. And so that's where we're looking for the 3 builds in 3 years. So just want to make that distinction as well. You can go to the next.
Okay. And I do have a question. Are we getting the materials after the presentation? Yes, you are. Look for an email from me in about an hour after the webinar ends. Look for it from Rose Waldy. I'm going to include the slide deck, and I'm going to include a copy of the recording so that you can rewatch at your leisure.
Thanks, Rose.
And we do financing for spec builds as well as build to rent scenarios. LendSure actually has an arm that focuses on DSCR financing as well on the non-QM side, and we'd be happy to evaluate a build to rent scenario to see whether it would fit our DSCR program thereafter, or our borrowers will typically shop around as you might expect. Loan amount, we could do up to 100% of the construction costs. That is another thing that separates us from other competitors in the space. And origination fees can also be financed into the loan, reducing cash at hand needed at the start of the program. This could be an example of, say, a borrower has purchased a lot in all cash, and they come to us and say, hey, I saw that you do 65% of lot financing, but I already have this lot owned free and clear. We would go ahead and say, you know what, we'll still apply that 65% to our initial advance, and you can go ahead and kind of use that as a cash out. In that scenario, they could wrap up loan origination fees and reduce their cash to close. An income doc is not needed to qualify, as we do bank statement financing.
Okay. And what is a DSCR?
So that is a loan where it's calculated on the debt service coverage ratio. So we just take the expenses less the income and create a loan based on those factors. Really, it's a takeout loan, paying this loan off after the 12, 18, or 24-month period for a rental more than likely.
Got it.
All right, so just stalled construction projects. Again, this is one where some people don't like to call it stalled construction, mid-construction maybe, but basically you have somebody who has purchased a property and it's mid-construction. Maybe the contractor has started on something and absconded with the funds, hopefully not. Borrower may have run out of money to finish the project. We would look very closely at that. We don't necessarily want to throw, let's say, good money after bad, so to speak. So we want to make sure that the scope of the project, the investor knows exactly what it's going to take to finish that project. We'll look at those, but typically we're looking more for somebody that is mid-construction and there is some issue or situation outside of their control, or they're purchasing a property where somebody just got halfway through and could not finish it. Maybe the previous loan is being called. Again, we're going to look at that a little bit closer. And then borrower mismanaging the costs associated with the project. Again, that is going to be a lot of scrutiny to make sure that they can finish the project with the new funds. But we will look at all of those to see if there is something that we'd be able to do on that front. You can go to the next slide. We do bash and build, where exactly what it sounds like. You're buying an existing structure, you're taking it down to the ground, and you are putting a new structure there. We would categorize that, if you take it all the way down to the foundation, as a construction loan. If you took it down to the studs and had a wall, we would categorize that or look at that as a fix and flip. So we would look at a bash and build, and we do those all the time, where the property is just better off being taken down and starting over. Go to the next slide. The loan application process, we try to make this as simple as possible. There is no MISMO 3.4, there is no 1003. We basically have a simplified application process. We send a link out, or a link is available. You put in the data points, and we basically take those numbers and create a term sheet. We'll reach out, make sure that we're putting together something that is going to make sense for you. But we issue a term sheet on what we're able to do. When that is agreeable, we drop that in a DocuSign for a signed term sheet. That comes back. There are a few documents that you provide, purchase contract, the scope of work. We pull credit, and that goes into ordering the appraisal. We then get it to underwriting, and we work on the conditional loan approval till we get it to clear to close, and then we fund it. The funds basically are reimbursed based on a third-party inspection of the work completed, basically the draw process, and we have an engineering company that goes out first they review your scope of work, make sure everything is feasible. Once that is done, they go by that scope of work when they go out to do the inspections. And we'll get into the draw process and how that works in a second here, but that's basically our process. We have closed, and it is, I guess, little time is a couple of weeks. Everything has to sort of be in place for that to happen. But again, we understand that a lot of files that we get, the close of escrow has already is inside 30 days or about 30 days, and so we move with speed on all of those things.
Okay.
You can go to the next slide.
We did have a couple of questions on how long this whole process takes, but you said as little as 2 weeks.
So my underwriter may come through the door here and hit me for saying as little as 2 weeks, but if everything is, and when I say everything, what we're waiting on primarily is going to be the appraisal. That appraisal, the appraiser is sent a scope of work. They're going to give us an as-is value. They're also going to give us an after repair, after renovation value. If you're doing a ground-up construction loan, you're also sending them the architectural plans, and so they're creating or building that appraisal based on comps that, you know, the future build is going to look like.
Mm-hmm.
Those things can take anywhere from 7 to 10 days in some instances. While that's being done, we're working through the conditions, and so that 2-week period, if all things are I guess, put together and everyone is moving quickly, yes. I would say 21 to 30 days is more typical, but yes, if everything's already in our hands, we can move within a couple of weeks to the close.
Okay.
So this is just a shot of what you would your view, I guess, when you are sent the link or you go to our portal. You just you know, start going through a number of prompts, a number of fields, almost kind of like a Google Forms. And once you hit submit, that drops it into our database, and that's when an account executive is assigned to you. They reach out to you, and then they work on getting that term sheet. But this is basically the opening page of that portal.
And you guys can find a link to the application on our website, which is LensherHomeLoans.com. You'll be able to find some program information, not only about our fix and flip program, but about our other available loan options, just like the DSCR that he was talking about recently. We do these loans as fix and flip. Carolyn, I'm not sure what you mean by these loans, so please go ahead and rephrase that question. I think this application, if that's what you're referring to, it is for both ground up construction and, the new constructions. Do we do those as fix and flip? Raymond.
Yeah, I'd assume that it would be submitted the same way that we would submit a fix and flip submission.
Yeah, okay. If that's the question, the submission comes in, you would just simply, you know, we're asking for purchase price, and there'll be a drop down. Is it a existing lot that you're looking to get that 65% initial advance on? Are you buying the lot along with the construction costs? All of those will have prompts, and so by the time it gets to us, we're going to know if they already own the plot of land, if they're looking to buy that land, if it's a fix and flip purchase, or if it's a ground up construction. So all of those will be fields that you'll fill out, and by the time it gets to us, we'll have a good idea of the program that you're looking to do.
And keep in mind that before you submit the application, or if you have some questions about the process or anything like that, our team is here to, you know, you can talk to either of these guys or someone else on our fix and flip team to go through your project, answer any questions if you're not comfortable submitting the application right away.
Absolutely. No, good point, Rose.
Yeah, we are always available.
What we're looking for in a package, again, don't want to necessarily belabor this, but we're looking for assets, so there's no, again, income docs per se, and we're just looking for the most recent statement or statements that would convey those assets. Those assets should cover, if it's a purchase, the down payment or cash to close amount. We like to see 6 months worth of the payment as an asset as well. And for budgets that are north of 250,000, we want to see 10% of that budget as an asset. If folks are a little short on assets, we can create a reserve account where we build the payments into the loan itself. That way they don't come out of pocket for, let's call it 6 months, and we don't have to show that as an asset. The credit, 660 minimum, that scope of work, that becomes basically the centerpiece of the loan, because that is the difference between the home as it exists today and what that new home is going to look like after the renovation or after the construction. How the draw is scheduled or structured. The LLC, that experience form, we send out an experience form. We verify that through property profiles to make sure that those experiences were closed in that person's name in the last 3 years. Look at the property itself, make sure it is, when the exit strategy comes, it is going to be a house that is desirable for the majority of the population. A working farm or 40 acres, that becomes a little bit more obsolete. So we're looking for things on that property that would allow us to, or allow you to have an exit strategy. The feasibility study, that's that third-party engineering company that goes and makes sure that the line items and what you're putting in that scope of work makes sense. And then we do require builder's risk insurance. If you do not have the access to an insurance company to do that, we provide a number of names of different insurance brokers that can provide that to you.
Dave,
yeah.
Do we order the feasibility study, or does Lensher order the feasibility study?
Lensher would order that feasibility study, and we use an engineering company that goes out across the entire US, and they're the ones who are also going out and doing the inspection. Once you say the work has been complete, I finished the bathroom, please give me the $10,000 for this line item. We send them out to the field, they take some photos, they send it back to us, and they say pay them their draw that comes in the next day, and we pay it out. But that engineering company does the feasibility study, does the inspections, and then okays the draw to be reimbursed.
Okay.
The draw process. So this is another area where we sort of separate ourselves from the competition. We do this in-house. We can send an inspector out. Let's say the request comes in at 10 in the morning. We can get the inspector out the same day. Obviously, the human being aspect is there. They may have to go out the next day or whatever the schedule is, but we like to say 24 to 48 hours to get them out. They go out to the field, they send it back into us, and as long as everything lines up on their end, we can have that draw dispersed the very next day. And that is wired straight to the investor. We do not pay the GCs, we do not pay the builders. That money is the investors to then pay their GC or their builders or material, whatever it is. So our draw process is very quick and in-house versus waiting 2 or 3 weeks or having a third-party draw process, which a lot of competitors do. Next slide.
Yeah, here's a few bullet points on our strength. Like I showed you guys earlier in slides 2 and 3, we do mid-construction stalls, which a lot of people will shy away from just because of the risk involved. But again, we typically just look, make sure the deal follows the 4 legs of the stool. If we like it, if the borrower is experienced, then we'll go ahead and take on those projects. Aggressive look at first-time investors. Even with the 660 FICO, you can get up to 80% of the loan-to-cost basis, which not a lot of others will do. Heavy construction projects considered. Definitely don't shy away from those. And there is an ability to collect a portion of the origination fees up front and then a balance at payoff as well. So, if the loan officer or the broker or we are charging 2 points on the deal and the borrower only wants to come out of cash for 1 point up front, we could structure the deal where the remaining point could be paid off at sell of the home or refied out. And that's, that could come into play a lot when borrowers might be strapped on cash and it has to happen to make the deal work. And then we do have the ability to set up escrow to overfund the loan to accommodate borrower payments. And we can do up to 6 payments based on their experience, credit, and other attributes. And this could also be very helpful as well to make sure that it's a streamlined process throughout the first 6 months of the project.
Absolutely. Not that it's talked about in that slide, and I don't want to get too deep in the weeds with this, but the experience itself, we're looking on the fix and flip side, 0 to 2 experiences in the last 36 months, we're doing 75 to 80% loan to cost, where they're bringing in the 20%, skin in the game. Once that goes to 3 flips in 3 years, we can go up to 90% loan to cost, and the skin in the game is then 10%. A little different, a little bit more conservative on the construction side, but if you have somebody that is a, let's say, experienced builder, we can also take those up to 90%. I would say in a lot of cases, those are landing at 82.5 to 85%, but there are different levels just based on that experience. And so that's where you'd call in and try to find out exactly what kind of leverage you'd be able to achieve just based on that experience. Getting into this slide, the 2 exit strategies that we have, you're either going to sell it or you're going to refinance that, a takeout loan or a DSCR loan. If you're going to rent it, fix and hold, or a build and hold, or a build and sell. And so we're looking to have certain tests done to make sure that your costs do not exceed what that after repair or after build value is going to be. And so we're always setting you up to either make a profit immediately with the sale, or within 12 to 18 months if you're going to hold. So those tests are done after we build those loan to costs ratios out, just to make sure that you're not getting into a project, or a first time investor is not getting into a project where they're not going to have a profit when all is said and done. You do next. So DSCR, again, this is going to be on our non-QM side, but basically there's no other income documents required. It's basically using the ratio of your income. You're basically completing the REO. You don't need to have any mortgage ratings on the other properties. Don't need to verify taxes and insurance. We can basically close multiple loans for the same investor at the same time. And here again, fast closings, minimal conditions, and that would be our counterparts on the non-QM side once this loan is, once a rehab has been completed, and you're looking to do a fix and hold or a build and hold.
So the DSCR would pay off the fix and flip loan?
That's correct. So our terms are going to be 12 months, 18 months, 24 months, and the DSCR loan on a fix and hold, if you're not planning to sell it, would be the more long-term loan that you would take out to pay off the loan, the rehab or the construction loan.
Understood. Now, this is a resource that I have for any realtors that are on the call. It's a white paper that I put together, and you can find a link. I'll send you guys the link to it in my thank you email in about an hour. But this is basically not just about fixed and flip and DSCR, but a ton of other loan programs. And so that when you're working with your buyers, you can find loan programs, whether they're self-employed, whether they're property investors, etc. We have a ton of different options. And so this comprehensive guide is going to just take you through all of that. This is another resource if you guys are, if we have any realtors here on the call, and this is just basically go to lyncherhomeloans.com, and under resources, you'll see the Realtor Resource Center. It's got flyers and infographics and videos and white papers and stuff. And if you guys want to go deep into these loan programs, this is another great resource for you investors to go in and just kind of get an overview of stuff, watch some videos, and there's also recorded webinars on there as well. With that, please go ahead and submit any final questions. Our speakers here will be happy to answer them for you. This question pertains to LTC, I guess loan to cost. How do you guys calculate the cost basis?
Cost basis is going to be, let's use a fix and flip purchase. We're going to take the purchase price, and then after the investor has walked the property and understands the renovation budget, we take that renovation budget, we add those two numbers together, that becomes the cost basis. Then we apply our loan to cost ratio based on those four legs of the stool to that cost basis. So if you have a $400,000 purchase and a $100,000 renovation, we have a $500,000 cost basis. Let's say you qualify for 80% because you're a first-time investor. That loan amount would be $400,000. We would then back out the $100,000 construction budget and fund that at 100%, leaving $300,000 for the purchase of that $400,000 property. On the construction side, we're going to take whatever was put into either buying the land. We can also include soft costs in there, permitting and different plans that you get from your architect. We then add that to the construction budget. That again becomes our cost basis, and we apply our loan to cost ratio to that cost basis.
Okay. I have a light rehab that I think I can sell in 6 months. Would you guys consider a term less than 12 months in this scenario?
So we like to do our fix and flips in 12 months, and that is really for the protection of our investors as well. Sometimes those you finish the renovation quickly, but the loan may, or the property may, sit on the market, or you don't sell it right away. There is no early payoff. There's no prepayment penalty. So if you pay this off in 90 days, then you're going to make that in profit. So we set them up for 12 months, but there is no penalty if you pay them off much earlier than 12 months.
And building off Dave's answer, there are some scenarios where if the deal happens to pencil out really well, we'll even bake in 6 months of interest reserve. So if the borrower thinks he can turn the property within 6 to 9 months time, he'll essentially have 6 months of no payments. So, that could be really beneficial as well.
What is the max allowable loan amount as a percentage of ARV?
So we have a few different, well, maybe not a few different, a couple different calculations there. We have some states that are judicial foreclosure states. We have others that are not. So we like to run that test no more than 65% in a judicial foreclosure state, and 70% is the norm in most states. So we don't like the cost to exceed 70% of what that after repair value is going to be. Again, that's a good 30% to 35%. That's going to take on all the carrying costs. If you have commissions that you're paying for sellers agents, things like that, all of that is baked in. So we don't like to go over 70%. Now, on the more experienced upper echelon experience, we can go up to 75% in some cases. So anywhere from 65 to 75% would be our after repair value sort of threshold.
Okay, great. And if any other questions come up, feel free to respond to the email from me, Rose Waldy, that you'll get in about an hour, or you can email renovationloans@lensure.com, and that will go directly into our fix and flip team, and they're very good at being very responsive. So you should be able to start a conversation right away. So with that, again, you're going to be getting an email from me. Keep an eye on it. I'll have a copy of the slide deck. I'll have a recording so that you can rewatch it. And I'll include the renovationloans@lensure.com email address in that as well. For my speak, I want to say thank you for everybody for joining us. And Dave, any parting words for our audience?
I would just say, just to piggyback what Rose was saying, we are very responsive in terms of questions coming in, scenarios. We look at them all the time. So never feel like you're, if you don't understand it, it's okay to call in and somebody will walk you through it and just really get you to a point where you are able to understand it, you feel good about it, and we're always there to respond to any questions that you have. So we're happy to help.
Awesome. Raven, any parting words?
Yeah, pretty much just what Dave said. And if you need any help, I'm always available. And feel free to reach out anytime if you have any questions and want to follow up after this webinar and dig into anything further.
Awesome. Well, thank you so much, everyone, for joining us today.
Thank you, Bryce.
Thanks, Rose.